In February 2020, I had been watching the progression of the coronavirus across China and thought it was only a matter of time till it would spread to other countries. Anticipating an economic shock, I actually sold all my shares. Then a day or two later, I let the fear of missing out get to me, along with my rational thinking that index funds are very diversified and the risk of losing all my money is quite low. So I went ahead and bought them back. And a few weeks later, the stock market crash happened. Of course, I wish I had listened to my gut instinct, but sometimes we're too afraid to question the convention and rather simply accept it. It also got me thinking that given sufficient information and skill, someone could actually outperform the market. Bill Ackman famously followed on his instinct on the coronavirus and turned $27 million into a staggering $2.6 billion. Similarly, Michael Burry famously shorted the market before the 2008 crash, as some of you may also have seen portrayed in the movie The Big Short, where Michael Burry is played by Christian Bale. Did they just get lucky? Are they just the result of survivorship bias, where you only hear about the winners and the losers just don't get the attention? These are good questions, and Spiva, hope I'm pronouncing that correctly, tracks the performance of the S&P index fund versus the actively managed fund for different categories, for example the small, medium and large cap. So every year they publish their results on their website. The link is in the description in case you'd like to have a look. Their analysis shows that between 74% and 93% of actively managed funds underperform their benchmarks over a 15-year period. You can read this sentence in two ways. One way is that the majority of active fund managers underperform the market, which is something we've heard time and again. The other way of looking at this is that between 7 and 23% of fund managers consistently beat the market. Now that's not a majority, but it's not a small number neither. Ask yourself, what's the threshold where we think active investing is useless because passive funds outperform them? It's a bit like playing the lottery. What are your odds of winning? 1 in 140 million actually if you're playing the Euro Millions. So extremely unlikely. So back to the active management example, what are your odds of beating the market or the index? If you ask me, 7% to 23% is a pretty good odds. And as opposed to winning the lottery, which is purely random, you have some control over which funds or which fund manager you choose. So actually your true odds of beating the market can be higher or lower depending on your skill. So I'm a bit apprehensive when people tend to bulldoze the idea that active investing is dead because they probably haven't considered these angles. If you can't pick the best stocks yourself because you don't necessarily have the time, resources and skills to do so, is the next best alternative picking actively managed funds? The answer to this depends on your ability to pick the right fund manager. Jack Bogle famously said, if you can't buy the needle in the haystack, buy the haystack. Using this analogy, picking the right fund manager is like buying the people who are excellent at buying the needle in the haystack. And if you're better at evaluating people than stocks, this may be a better choice. So who are these excellent needle buyers? Well, Warren Buffett, Cathie Woods, or perhaps Bill Ackman or Michael Burry. Whoever it is, the reality is that you would have beaten the market if you had invested with those people. I also don't think there are any fundamental rules that say you cannot defeat the market. That is, in other words, I think active management is simply how good of a forecaster you are. And we all know that forecasting the future is very difficult, and it depends on the information and skill at your disposal. That's no surprise then why most active fund managers fail. Equally, however, we all know how skill varies and that the majority of us will be bad at this prediction exercise, but some select few geniuses will outshine the rest of us. Now that we're coming to the end of the two-part series on active versus passive investment, which one do I recommend? While most channels will probably tell you passive investing is better, I would say it depends on your skill set as an investor. For beginners and general investors, I would recommend passive investing as index funds are a low cost, well diversified, decent return and minimal effort investment. For some investors, however, their choice of active fund managers will beat the market returns. The real question is, are you good enough to find them? And that concludes my take on the debate. Speaking of investing, if you're keen to check out my investments and performance to date, feel free to visit my eToro profile. I will hopefully give you a portfolio review in the next few weeks. Thank you for watching. Please remember to like and subscribe. Until next time.